while being slightly fast-paced. As of this moment in live trading, shares of Lithium Americas Corp., ticker LAC, are trading at $8.99, down about 0.5% on the day. The stock opened significantly higher, touching $9.48 before pulling back, showcasing the intense volatility that has gripped this name. But to focus solely on that intraday swing would be to miss the monumental story unfolding just beneath the surface. The simple expectation is that this is just another volatile mining stock beholden to commodity prices. The reality, however, is that Lithium Americas is at the absolute epicenter of a geopolitical and economic supercycle, a focal point of the United States' desperate push to onshore its critical mineral supply chain. Recent news involving a massive Department of Energy loan and a direct equity stake for the U.S. government has transformed this company from a speculative venture into a quasi-strategic national asset. Yet the market's day-to-day reaction seems almost schizophrenic, unable to price in this paradigm shift. The common belief, the one circulating on forums and social media, is that owning Lithium Americas is a straightforward bet on the electric vehicle revolution, a simple proxy for the success of giants like Tesla stock. If EV sales go up, lithium demand goes up, and therefore LAC stock must go up. This is a dangerously simplistic narrative. The deeper reality is that LAC is not a story about EV sales figures next quarter. It is a high-stakes, multi-billion-dollar construction and engineering epic centered on a single colossal asset, the Thacker Pass mine in Nevada. This project is a behemoth, the largest known lithium resource in the United States, and its success is far from guaranteed. It's a tale of massive capital expenditure, immense operational hurdles, and the ever-present risk of commodity price fluctuations. An investor making decisions through the SoFi Invest or Robinhood app based on the simple EV narrative is ignoring the complex reality of building a world-class mining operation from the ground up, a process that will take years and billions of dollars before a single ton of battery-grade lithium is sold. Let's dissect the recent stock movement because it tells a fascinating story of this tension. The stock has been on an incredible run over the past month, surging on news that the Department of Energy was finalizing its landmark $2.26 billion loan to fund the construction of Thacker Pass. The market correctly interpreted this as a massive de-risking event. Government backing of this magnitude is a powerful endorsement. But the plot thickened considerably with the revelation that the deal terms included the DOE taking a direct 5% equity stake in the company and a 5% economic stake in the Thacker Pass project through warrants. Initially, the market cheered this alignment of interests. However, in the days that followed, some analysts began to downgrade the stock, like TD Cowen moving from a buy to a hold, arguing that the massive run-up had gotten ahead of itself, and that the market had fully, perhaps overly, priced in the good news. This created the push and pull we see today, with the stock hitting new 52-week highs before facing profit-taking and consolidation. Trading volume has been immense, frequently multiples of its daily average, indicating that large institutions are actively repositioning. This isn't just retail speculation on Robinhood stock trading. This is significant capital flowing in and out as the market digests the long-term implications. For those engaged in self-investing, understanding these institutional flows, often visible through platforms like interactive brokers, is critical to navigating the volatility. To truly grasp the opportunity and the peril, one must understand what Lithium Americas is. The company, following its separation from its Argentinian assets, is now a pure-play U.S. lithium development company, entirely focused on Thacker Pass. This isn't a company with a portfolio of mines, it is a single asset story. Thacker Pass is designed to produce 40,000 metric tons of battery-grade lithium carbonate annually in its first phase, enough for roughly 800,000 electric vehicles. The project is fully permitted and construction is well underway, with hundreds of workers already on site. General Motors is a key partner, having invested hundreds of millions and secured a significant offtake agreement for future production. This is the bullish expectation, a fully funded, permitted, world-class asset in a politically stable jurisdiction with a guaranteed anchor customer, all backstopped by the U.S. government. It's a narrative that appeals to anyone looking for investment help in the green energy transition. It's the kind of story that fits neatly into Fidelity ETFs focused on battery metals or clean energy. However, the reality of execution is where the risk lies. Major construction is progressing, with a target for peak construction in 2026 and initial production potentially starting in 2028. This is a long timeline. Between now and then, the company must manage a complex construction schedule, navigate potential cost overruns in an inflationary environment, and ramp up a workforce that will peak at nearly 2,000 people. Any significant delay or budget increase could pressure the company's finances, even with the DOE loan. Furthermore, the global price of lithium remains a critical variable. While forecasts suggest strong demand growth, the price of lithium carbonate has been notoriously volatile, falling sharply from its 2022 peaks before stabilizing. LAC's project economics are robust, but a sustained downturn in lithium prices could impact future profitability and the market's perception of the stock's value. This is the kind of specific, single-stock risk that diversified solutions like Schwab Intelligent Portfolios are designed to mitigate. An individual brokerage account with Fidelity or SoFi gives you the freedom to invest in LAC, but wisdom dictates it should be part of a broader strategy. Looking toward the future, the outlook is a fascinating duality of immense potential and significant operational risk. The bull case scenario is incredibly compelling. If construction at Thacker Pass proceeds on schedule and on budget, and if lithium demand continues its projected climb, driven not just by Tesla stock, but by the entire global automotive industry's electrification, Lithium Americas will be perfectly positioned. It will be one of the only large-scale domestic suppliers of lithium to the U.S. battery industry, a position of immense strategic value. The partnership with GM and the backing of the DOE provide a level of security that few other junior miners possess. In this scenario, the current market capitalization could seem minuscule in hindsight, and the stock could re-rate to multiples of its current price. Conversely, the bear case cannot be ignored. The primary risk is execution. Large-scale mining projects are notoriously difficult to deliver on time and on budget. Any significant stumbles could erode investor confidence. The second major risk is the commodity price itself. Should there be a breakthrough in battery technology that reduces lithium intensity, such as the scaled commercialization of sodium-ion batteries, or if a wave of new global supply comes online faster than expected, it could pressure prices and compress LAC's future margins. This is where active online investing requires constant vigilance, monitoring not just the company, but the entire sector, from the NVIDIA stock powering the AI that optimizes mining to the Apple stock driving consumer electronics demand for batteries. Now is a good time to get your thoughts in. Comment below what you believe the final construction cost of Thacker Pass Phase 1 will be relative to the current budget. In summary, the story of Lithium Americas is the ultimate embodiment of the tension between a powerful, world-changing expectation and a complex, challenging reality. The expectation is a simple, can't-miss bet on America's energy independence and the EV revolution. The reality is that this is a formidable, multi-year industrial project with inherent execution risk tied to a volatile commodity market. The involvement of the U.S. government and General Motors has dramatically lowered the financial and political risk, creating a foundational support for the company's valuation. But it does not eliminate the geological, engineering, and market risks that lie ahead. The recent surge and subsequent volatility are the market's attempt to reconcile this grand vision with the gritty details of execution. For the serious investor, the path forward requires looking past the daily noise and focusing on the company's ability to hit its construction milestones, manage its budget, and navigate the ever-shifting landscape of the global lithium market. The ultimate success or failure of an investment in LAC will not be determined by today's price action, but by the concrete, steel, and operational excellence demonstrated in the Nevada desert over the next 3 years.